Hi, this is Mike Lembeck with Remax Commercial, bringing you today's Let's Talk About It. Today's article is the analysis. Multifamily is doing fine. So a lot of people are concerned with the recent interest rate increases that multifamily is potentially going to lose its attractiveness as an investment. I think there's some points in this article that you'll find are pretty right on as far as the analysis goes and how we can anticipate things to move forward here in the future. Recent reports about the multifamily sector indicate slowing rent growth and a slight downward trend in occupancy. Also concerning has been what multifamily investor CP Capital dubbed the disruption and ambiguity caused by stubbornly high inflation and the Federal Reserve's ongoing strategic rate hikes. So those are all the points that a lot of people are concerned about that are potentially going to be harmful to the multifamily market and investor. But the CP Capital's advice is not to worry about multifamily. According to the company's January 2023 report, the sector remains strong due to ample dry powder, a structural supply-demand imbalance, and favorable employment, income, and demographic need or trends. So all of those are the positive that are behind the potential resurgence of multifamily as the market and the economy becomes accustomed to the recent rate hikes and rents continue to increase. Potentially, property prices do drop a bit, and there may be some leveling off there of the two factors that will kind of put us back to where we were, maybe not last year, but in previous years before the recent rent hikes or the rent increases that we've experienced. One reason not to push the panic button is because the monster double-digit rent growth stats experienced in 2021 and much of 2022 were simply not sustainable. They were just high, just an unnormal or out of the norm rent increases that occurred during those times due to the pandemic. And following in the footsteps of those unsustainable heights was always going to be a daunting task, especially as investors and renters alike grew comfortable in the ultra low interest rate environment. In fact, in the face of increasing interest rates and other factors, the institutional multifamily developers and owners are hitting the pause button on investment and building until things settle a bit. As I just had stated, that I think we just need to get accustomed to some of the new interest rates, and we had just really extremely low interest rates there for 2021 and 22, which was just driving the economy. Interest rates were never that low in the past, so that was just keeping the economy going. Now we've got more with these recent rate increases, and more of a normal market that I can see that potentially we just have to get used to because we were kind of spoiled with those really low rates. The what's been experienced now is the seasonality of multifamily, which is an acceptable slowdown in the days prior to the pandemic. But what about transactions? So we've had a slowdown in transactions quite a bit. It's probably less than 50% of what we had over the last couple of years with the increase in pricing and everyone paying more than the asking price, multiple offers. So the report noted that the decreased valuations and increased cap rates should be taken with a grain of salt due to the unique nature of most recent sales. This is because rents and NOIs remain strong. Furthermore, sales pricing should improve once buyers return to the market. This will happen in the second half of 2023. At that point, it's likely that the Federal Reserve could stop boosting effective federal funds rate. Now, they just increased the rate yesterday by a quarter point. So hopefully they only have one other quarter point increase coming, and then potentially they'll pull back and kind of just wait and see what the effectiveness of the recent rate increases have had on the economy, inflation, and everything else. Unfortunately, our real estate market is suffering. Transactions, values, just everything has kind of just been put on hold and just stopped as far as anything as far as buyers wanting to buy. Even sellers are sitting on the sidelines waiting to see what happens. Additionally, CP Capital indicated that multifamily was an investment darling over the past decade for many good reasons. These include supply-demand fundamentals, demographic trends, and continued increasing cost of home ownership. So with the increasing interest rates, that's left us with a lot of renters who can't afford to purchase a home or would want to, but just are want to back off too because they think the values may come down and rates may potentially come down. Another strength of the sector is the amount of capital that remains on the sidelines. This capital will be deployed once things settle down. So again, more towards the end of the second half of the year, investors get accustomed to the interest rates where they're at, potentially coming down even. So I think you're going to see the second half of 2023 will be not as good as it was in 2022, but maybe something similar to what we had experienced prior to the pandemic. So feel free to comment or give me a call if you have any questions on the information I'm providing. Hopefully you found it of value. It's something that you can use in the future, and anything that you might need as far as real estate needs, valuation on your property, me taking a look at what potentially you can do in the future. Feel free to give me a call, send me an email, whatever, reach out to me in any way you need, and I'll see what I can do to help you. Thanks for watching, and I'll see you on the next one.